Bring someone that I've worked with for 15 years, multiple companies, worked side by side for 15 plus years. He started on the channel about 2 years ago, a little bit over 2 years. He brought to the channel an entirely new language, new vocabulary, and you know what? I almost forgot something. 1 second.
I need a nailed it t-shirt.
He didn't know, but you know we got to take care of your boy. So, anybody been following Dan and I's conversation on Sunday? Does anybody think one is enough nailed it t-shirts? Because I don't think one's enough. Now you have one for you and your wife.
All right.
No idea. They're all the same size. But at the end of the day, he has been right more than any person on CNBC, on Bloomberg. We've got receipts. 2 years of videos. Take it.
All right. Can you hear me? All right, very good. All right, thank you. Thank you, Mike. And as Mike said, I've known him for more than 15 years. We worked together side by side. He was actually my boss at one point. And he asked me to come on to talk about stocks. Now, I'm the only stock guy in a room full of real estate people. So please be gentle. I do want to make a comment about something that Ty said. So I am a proud boomer. And we are going to spend our kids' inheritance. So there's no transfer of wealth going on here. They have to figure it out for themselves. So, as Mike said, we've worked together, but I've been in the technology industry for years and years. I made most of my money from selling software. And as a result, I built up quite a nice nest egg. Now, my story is kind of similar to Mike's, and most of you probably know that he went into the stock market during the dot-com boom, lost most of his money as a result of that. The same thing happened to me. I lost most of my money as well because I had no idea what to do in the stock market. And I remember a nice quote from John Carter, who wrote a book called Mastering the Trade. And he said there are 3 stages of a stock trader. Stage 1, lose all your money. Stage 2, stop losing all your money. Stage 3, start making money. So when I'd lost at that point during the dot-com crash, my wife gave me a kind of a present. I think it was a birthday weekend away. We went to Philadelphia. But she bought us a seat in a seminar for how to trade stocks using technical analysis, which I love because I'm very analytic, number one. And number two, there's a lot of math involved, which I love math. At the end of that, I said, this is what I want to do. I love this. So from that point on, Mike and I's paths kind of diverged. He went to the real estate path. I started taking all the money I made. I maxed out my 401k, maxed out my IRAs, started saving and putting as much away as I possibly could. That was my war chest, if you will, to be able to use that to start trading stocks at some point in the future. Now, when I retired, I didn't have to retire. I could have kept working, but working was getting in the way of doing what I really love, which is stock trading. So I retired a couple of years ago, and now I do this full time. So what I'm going to do is I'm going to go through kind of the basics of technical analysis, and we'll talk about the market. Near the end, I'm going to talk about where I see things for the next year. As most of you that follow me on Zuber's channel, he asked me to make predictions. I make suggestions. I don't think you can predict anything. You can't predict the market. Nobody knows where it's going to go. But you can look at the tea leaves and look at the signs and see where things are headed. So I'll show you that near the end. I'm I also want to make a comment about Adrian's talk yesterday. Was that a great talk? It was very motivational, fantastic talk. So one thing that, one saying that I made up that kind of falls in line with what he was talking about is whatever you focus on, you will get more of. It doesn't matter if it's good or bad, positive or negative. If you focus on the bad, you will get more bad. So it's not that much effort just to focus on the good. And if you focus on the good and the positive, then you'll get more of that. So always remember that. The second thing I want to do, kind of based on what Adrian was talking about, is tell you a story. He talked about personal affirmations and, kind of making a video, making a recording of your own voice. One of the companies that I work for, software company, and they often, every year, they raise their quotas naturally, and everyone expected a 50% raise in our quota. We got a 100% raise in our quota. Our quota went from $2 million per year to $4 million. And my whole team and everybody around me said, there's no way we can do that. We barely made it last year. How can they expect us to double that? Well, instead of focusing on the negative part of it, I thought, you know what? I'm going to ingrain in my mind that I can do that. So I made a little recording, 10 minutes, 5 minutes relaxation. You can call it self-hypnosis if you want, but it was just 5 minutes of relaxation, and then 5 minutes of affirmation. But you have to be careful because your subconscious will literally take what you tell it. So you have to be careful of how you word things. So I didn't say, I'm going to make my quota. That's not specific enough. I said, by May 31st, which is the end of our fiscal year, so our quota had gone from 2 million to 4 million, I said, I will exceed 4 million in sales. So there's no limit on it. But I gave it a date, and I gave it the low end. And every time I would be on an airplane, every time I would travel to a customer, every night before I went to bed, I would play that recording over and over. The end of that year, I didn't do 4 million, I did 9 million in sales that year. And thanks, it was hard work. But I was in the top 10% of salespeople and took my wife to Bali for a vacation. So only the top 10% were able to take that trip. So it really does work. What Adrian was talking about, it really does work. It sounds great when someone's in a group like this talking about it, but you actually have to do it. You have to actually activate it and, take the responsibility to actually use your subconscious because it can really help you. All right, so now let's talk about the stock market. So how to make money in the market. First criteria, understand which way the overall market is heading. So that's the first thing you have to understand. So we're going to take a top-down approach from a wide view down to a very specific view. Trying to swim upstream. You don't want to swim upstream because you'll end up in a bear's mouth, right? So don't work against the market. Figure out which way the market is going and go that direction. So here's something about technical analysis. I love this cartoon. For those of you who get my newsletter, I have cartoons every week in there. So some people, I think, just read it for the cartoons, actually. But this says you should buy a stock whenever the chart looks like a squirrel sitting on a clown's shoulder. That's called technical analysis. I'm not going to do that. Good, because it doesn't work if everyone does it. It's actually the opposite. Technical analysis works because everyone does it. And I'll show you that here in a second. So here's a trader on Wall Street. He says, I always laugh at people that say, I've never met a rich technician. I love that. It's such an arrogant, nonsensical response. I used fundamentals for 9 years and got rich as a technician. So I'm going to show you what that means. So technical analysis is basically the visual representation of market psychology. You can visualize what other people are doing by using this. Shows you what the crowd is thinking. It's trying to figure out where the orders are. Sort of like, where's Waldo? But in this case, it's where's the orders? If you know where the orders are, then you'll know you can be patient and wait before buying. And you also will know where the orders are on the downside, so you'll know where to get out as well. So fundamental versus technical. So there's two groups. There's a fundamental group that says we just want to look at the intrinsic value of the company. There's a technical group that says we want to just watch the charts. Sometimes they don't like each other, but I think it's important to have both sides. So fundamental analysis is understanding the intrinsic value of the company, to understand whether they're overvalued or undervalued, looking at earnings, expenses, assets, liabilities, etc. Technical analysis, however, is the core assumption is that all known fundamentals are already in the price. So the price already has all those fundamentals included in it. So it's just a matter of understanding what direction it's going. So those are the two approaches. So everyone's heard of price to earnings ratio. That's a typical indicator for fundamental analysis. What's the PE of a company? But you might not have realized or thought about that price to earnings, the earnings part of that is fundamentals, but the price part of that is technicals. So you're really using both together, and that's really the key. So here, this is a really important slide. This is how the market versus the economy looks. And it's important for everyone to understand this because the stock market is about 6 to 9 months ahead of the economy. So when you hear things on CNBC or in the newspapers that says the economy is bad or inflation is getting too high or companies are missing their earnings, the market, the stock market, has already priced that in. So if you think you can trade off of what you hear on TV or in the newspapers, just remember you're 6 to 9 months too late. The market prices it in ahead of time. As an example, the Fed started raising rates in May of 2022. The market started falling in January of 2022. And December of 21 was the first time I started on Mike's channel, and I said then that 2022 was going to be a very bad year based on the underlying things that I was seeing. So the market is ahead of the economy. Don't ever forget that. These are kind of some of the areas. This is the more normal cycle: recovery, expansion, slowdown, and recession. Right now we're in the expansion phase. We may go into a slowdown phase, or we might not. There's a lot of things going on right now as a result of a 100-year pandemic that have made things very different than what they have been in the past. So we may get a recession. If we do, I think it will be short and shallow. And I'll explain why in a second. This is something that VectorVest is a platform that I use, and this is an interesting way that they look at where things are right now. So right now they have it as a case 3 bull market. So earnings rising, inflation falling, and interest rates rising. Now 1 week ago, the same one was up here as a case 1. Earnings rising, inflation rising, interest rates falling. That's when a bull market begins. In 1 week, it switched down to that one. So, but we're still in a bull market right now. So Jesse Livermore, very famous trader he made money. He actually lost a lot of money as a result of the 1929 crash, but he made fortunes and lost fortunes in his lifetime. Being a little late in a trade is insurance that your opinion is correct. Successful trading is always an emotional battle for the speculator, not an intelligent battle. Trading is not a get-rich-quick scheme. Neither is real estate. Real estate takes time, but if you work at it, eventually you can leverage all the work you put into it. Stock trading is very similar to that. I want to comment about being a little late in a trade. You can never time the market in the sense that you can never know when the top is and you can never know when the bottom is. But if you can identify the trend, then you can get the 80% in between. And that's what I try to do. Now, I am not a day trader, and I am not a buy and hold investor, and there's not anything wrong with either one of those. Everyone has a different view of how they want to invest or trade in the stock market. I'm more of a trend follower, so I identify the trend, I get in on the trend near the beginning, but never at the beginning, and then I ride it until I see that the trend is ending, and then get out. That could be 3 weeks, it could be 3 months. It just all depends. So that's kind of what I'm going to talk about. So how do we use them both together? Technical and fundamental analysis together. By analyzing historical financial data along with forecasted earnings, you can understand the fundamentals. By analyzing historical charts, you can identify the optimal entry and exit points, and that's important with technical analysis is it helps you understand where to enter and where to exit. The fundamentals help you understand what to buy. The technicals help you understand when to buy. So start with the fundamentals, understand the intrinsic value of a company. Don't buy at any old price. What you actually pay for a company's shares is the most important determinant for your future returns. What you pay, your buy point determines your profit. That's true with real estate as well. Use technical analysis to time trading decisions. Shares are under either an accumulation or a distribution phase. So accumulation, big companies on Wall Street are buying it. They can't do that in one day. It takes them a long time. It could take them months sometimes to take a position in something. So if you watch the volume and watch how the shares are traded, you can identify that early in the cycle and then get on and ride it along with the Wall Street traders. Same thing with getting out. Make your money on the buy, not the sell. This is true in any investment, whether it's real estate, business, or the stock market. How you buy something is the most important thing, not how you sell it. So I want to talk about the big picture now. We're going to talk about the big picture and then narrow it down. This is a really important idea that a lot of people, even the folks on CNBC, don't talk about much. It's about secular markets. Secular markets are long-term, over a long period. Cyclical are shorter-term markets. The secular bear market exhibits selling pressure within equity markets over an extended period. A cyclical market is a shorter in duration than a secular market. I'm going to show you what this looks like in a second. A secular bull market can have corrections or bear market periods within it, but they will not reverse the trend of upward asset values. In other words, any declines in the market are more than made up for by the extended rallies in the market. Keep that in mind. If everyone remembers 2022, when the market just seems like it was just going down as the Fed was raising rates, that was a cyclical bear market. Same is true for a secular bear market. So this is what it looks like over the last 100 years. So this idea goes back 100 years. Back over here, oops, let me go back. Over here is 1929, crash right here. There's a secular bear market that ended, went into a secular bull market. Secular bulls usually last about 18 to 20 years. Secular bears last about 12 years. So you can see right here in the 69 to 81 period was a secular bear market. And in 81, the secular bull took off, and it lasted until 2001 during the dot-com crash. From 2001 until 2013, we were in a secular bear market. Since 2013, officially, because that's when it broke out of the high, we have been in a secular bull market. You could count it from 2009, which was the bottom, right there, or from where it broke out above the previous highs, which is 2013. Either way, 18 to 20 years gives us till 2029 to 2033, somewhere in that neighborhood, for a secular bull market. Now remember, secular means long-term. Doesn't mean you can't have corrections within that, just means that over the long term, it's going to go higher. This is what it looks like over the last 33 years. So right in here is the 2001 to 2013 secular bear. This is where we started the secular bull. And if you'll notice this moving average line right here, that is a 200-week moving average. So moving averages is essentially you take a time period, you take the last number, you add it on, and drop off the first one. So an 8-day would take an 8-day period and just keep moving it forward. That's a 200-week. You'll notice even during COVID, COVID's right there, during 2018, during 2011, during 2022, it never went below that 200-day weekly moving average. And we're right over here. We've actually broken out above the previous high right there. That's one of the calls I made with Zuber at the beginning of 23. I said, we're going to hit all-time highs again by the end of 23. Now remember, 23 was coming out of the bear market of 22. So nobody believed me, but we actually did it. We hit new highs the end of 23. The other two are momentum indicators, and that's how I've had people say, well, when will you say we're no longer in the secular bull? Well, when one of these up here turn red, then that's the warning sign that the secular bull market is over. But I don't expect that to happen for at least 5 more years. So the next step, once you understand the overall market, which way it's headed, the next step is to look at the individual sectors. Identify a sector that is moving higher. Right here, this is as of Friday, by the way. So this one right here, if it works, well. All right, so there's XLV right there, that's healthcare. So that's the sector that's moving up into the right leading quadrant. Next, we want to look at the industries underneath that sector. So the leading industry in the healthcare sector is healthcare providers. Next, we want to find the best stock in that industry group. And these are the top stocks. Number 3 is Oscar Health, right there. And if we look at the chart for Oscar Health, it looks pretty good. It's just moving higher. So that's the way you do it. You look at the overall market, you look at the sector, you look at the industry group, and then find the best stock in that industry group. That gives you the best chance of having that stock appreciate. All right, price and volume. Price and volume is really important. It's really the basics, the foundation of technical analysis. In a healthy bull, price makes a higher high and a higher low. That's how you can identify a bull market. During a bullish rally, the buying of the stock by those who are covering their previous short. So when people short a stock, they believe it's going down. So they bet on the downside. If the stock doesn't go down and starts going back up instead, in order for them to get out of that position, out of that short position, they have to buy. So you have ready-made buyers right there. People that had been shorting it, thinking it's going down, and then realize it's not anymore, so they have to buy. Secondly, people who are actual new buyers. So we think this company is going higher, we're going to buy it too. So now you've got the shorts covering, and you've got new buyers coming in at the same time. What happens after the rally? If the rally is due mostly to shorts, then it's likely to decline in the future. So it's short-lived and it won't continue higher. But if it's a combination of the two, the rally will continue much higher. In a healthy bear trend, the opposite happens. Price makes a lower high and a lower low. So this is the price to volume relationship. Price is rising, volume is rising. That's a strong uptrend. Price is rising, volume declining. The uptrend is weakening, etc. So this kind of helps you understand which way the market's going and whether it's a bull or a bear. All right, so this is kind of the last part about technical analysis. There's a lot more to it, but this is really important. This is support and resistance. So stocks, interestingly, kind of have a symmetry to them. And it's basically just supply and demand. So in this case, for support, when a price falls because there is an excess supply over demand, the lower prices go, the more attractive prices become to those waiting on the sidelines to buy. So there's people right down here that think this price is a pretty good price for this stock. So it's waiting for it to come down to that before they step in and start buying. It's just supply and demand. That's all it is. So that's support. And what happens is when they start buying, it goes back up. And all these people over here that thought it was going to go down, they start selling again, and it goes back down. But it's always to that same level. So that level is a support level. Same thing with resistance. Resistance is the opposite. So the price goes up to a point where people don't think it's worth that anymore, and they start selling. So they sell, it goes back up and hits it again, and they start selling, and it goes back up and hits it again. That's resistance. It can't get through it. It's kind of a ceiling over the price. This is the easiest one to explain the whole idea that I talked about with understanding where the orders are and what the trend of the market is, because if you think about it, this is the psychology of the market. If you think about it, the people right here, there were buyers right there, and then the stock started falling. Well, all of these buyers, they're saying, well, let me just get back to break even. I'm losing money, but I don't want to sell my stock. I want to keep it. Let me just get back to break even. And as soon as I get back to break even, I'm selling. I'm getting out. So this is a perfect example of market psychology. So it gets back up here, and they say, oh, great, we're back to where I was. They start selling. So it goes back down again, goes back up, gets to the same level, then moves back down again. So that's all market psychology. Same thing with a diagonal support line. It works the same way. So what this is, like I said in the beginning, where the orders are. That shows you where the orders are. That shows you if you bought this stock down here, you might want to think about selling it, where all of the sell orders are. And when you bought this stock up here, or when you watch this stock right here and you know where the orders are down here, you might want to wait till it gets there. Be patient. Don't find a good stock and just jump into it right away. Look for where the support is. Be patient. Wait for it to come back down to that and buy it there. And that's your best chance to make the best profit. All right, so support and resistance, short-term volatility is greatest at turning points and diminishes as a trend becomes established. So the best time to buy it is right at that support and resistance level, or sell it at resistance or buy it at support. And then over time, it starts to dissipate. All right, so the last thing I want to do with technical analysis here is say, okay, well, what could this have helped us in the 4 big bear markets of the last 25 years? Could technical analysis have told us to get out before we got destroyed? So I'm going to look at each one of these. So this is the dot-com bear market. And what you see, I don't like this pointer. Try a different, I actually came prepared.
That's the damn bird I remember. You always got to back up to the back.
Right. There we go. That's better. All right, so here's .com. Now, I'm going to explain these. These are moving averages right here. As I said before, it's taking 8 days and just adding the new one on, dropping the last one off, 21 days, 50 days. But the 8-day will move faster than the 21-day because it has fewer days. The 21-day will move faster than the 50-day. All right? So you can use these to see when they cross. So when these cross to the downside, when the faster one crosses the slower one to the downside, that's the time to sell. Now, in this particular case, remember, this is 2000. As the market was going up, it just kind of stalled right there. Started going back down. They both crossed right there. Then it broke through this trend line. Remember the diagonal trend? It didn't bounce right there. It broke through it. So that's the warning sign. Here's another horizontal trend line right there. It broke through that as well. So that's the warning right there to get out of the market. Okay, now what happened after that? If we had used technical analysis and got out right there, then what happened after that? That's what happened. All right? So we would have been out right here, or at the worst case right here on this horizontal one, and we would have saved ourselves all of that pain all the way down. And by the way, it also helped us understand where to get back in. As it went sideways down here, you can see the support level right there started back up as the moving average lines crossed. So that's the dot-com period. How about the great financial crisis? So same thing. This is what the chart looked like. 2007. There's January of 2008. The market was going up. It started to come down, and notice the lower highs. Remember what I said about a bear? It's lower highs and lower lows. That's how you identify whether we're in a downtrend. Well, you can see the lower highs and the lower lows right there. So right away, we know that we're in a downtrend. We watch these moving averages right here, and they all crossed right in this period right here. So basically December of 2007. That was the warning sign to get out of the market. And what happened after that? That's what happened. So technical analysis would have got us out right there and would have got us back in right there. Now, the hard one, COVID. Everyone remember how fast the market went down for COVID? Lost 35% in a week, 2 weeks, I think. All right, this is the COVID crash, but you would have had to have been pretty quick on this one. There's the support line right there. There's where the moving averages crossed. There's where it dropped through support, so that's the point right there to get out. Now, there were signals, if you were aware, and I actually got out of everything right here in the beginning of February because of all the news about this new variant, and because I knew from history that pandemics usually come back every 100 years, and the last one that we had was 1918. So I knew it was very likely that this was going to be a worldwide pandemic. It's a 100-year pandemic, and we were just about at the 100-year point, a little bit over it, actually. So I got out early when I started hearing the news about the pandemic, but that's what technical analysis would have told you right there. What happened? Very short one, short-lived, and you can see the bottom right there was 2020, March of 2020, and then everything went up from there. And this is the most recent one, 2022. This was a cyclical bear market. Remember, we're in a secular bull. 2022 was a cyclical bear that went down during that period. But same idea. If you watch the moving averages, you watch the support lines right here, that's the point to get out. You would have had another chance right here when it came back up and tried to break out of this but couldn't and started down again. So that would have been either right here in January of 22 or in April of 22. And there's what happened. So I hope this helps you understand that technical analysis, once you understand how it works, can really help you with entries and exits. If you're just a buy and hold investor and you have a good company, you don't have to worry about any of this. Just hold it for the long term. If you just buy the S&P and hold it for 20 years, in general, you're going to make about 9%. And for those that don't want to be investing or trading in the market, that's a great way to do it. Mutual funds, I'm not as bullish on because mutual funds try to distribute your gains and losses across many different companies, and it's usually just going to be average or less than average. All right, so let's move on to, so don't swim upstream, basically. What happened? Last call? Is it last call? No, there was more. There's more slides. There we go, okay. All right, the most contrarian thing of all, and this applies to life in general, is not to oppose the crowd, but to think for yourself, right? So there's lots of people around today that should take this advice. Think for yourself. All right, so now I'm going to talk about where we are right now and coming up over the next year. What does the next year look like? This comes from Stock Traders Almanac. Their business is all about looking at market history back more than 100 years ago. This is over a 21-year period. This is what the month of February normally does. And you might notice here where we are right now. You're here. Here's President's Day tomorrow. This is Tuesday's market. We're right there, and notice what the market does starting next week. Okay? So, what happened? Oh. All right, so keep that in mind. So this is over, since over 21 years. That doesn't mean the market's going to do it again. This is an average. It could be an outlier. It could go a different direction. But on average, the important thing about these, looking at history, is it helps you understand the probabilities. It's not a prediction, it's not a guarantee, but it helps you manage risk. Helps you with the probabilities of what could happen. This is something that was put together by a guy that I subscribe to, that he took every election year back to 1950, and he took how those election years ended, every single one, and regardless of who won, doesn't matter if it was Democrat or Republican, didn't make any difference, this is what the market looks like over almost a 75-year period. Notice where we are right now, right here, and notice what typically happens over the last 75 years during an election year. There's a big downtrend in March. In fact, March makes the low of the whole year. So if anyone's thinking of buying something, I would suggest you might want to wait till March and watch to see if the market goes down. Then the market goes up, and it goes sideways and through here. So this July-August time frame is basically where the conventions are. And then there's a big dip right here just before the election. So October, there's another big dip, September-October time frame, just before the election. So the market does not like indecision. Once an election happens, the market usually takes off. Regardless of who wins, Democrat or Republican, the market normally takes off. So let's look at this from Stock Traders Almanac. They did the same thing. This goes back to 1949, so 75 years. What you'll see is we are right here, right now. There's the dip in March, so they saw the same thing, March with a big dip. This green line represents when there is an incumbent president running, which is what we have right now. Again, doesn't matter who it is, doesn't matter the party, doesn't make any difference. This goes back 75 years. With an incumbent president running, the market usually ends up much higher. Now, the market usually ends higher during an election year regardless, but if it's an incumbent, it's usually much higher. Notice the red line. This is when it's an open field, when there's no clear person running in either party. We still get the March decline right here, but because we're on the green line right now, February is up, and we probably will go down in March. So we're right now on the green line. That's it. That's it. All right, next call. I'll talk through this while he brings it back. The green line is what we're on right now. The red line is with an open field. If something were to happen in either of these conventions, let's say Biden decided, maybe I am too old, maybe I'll step aside, I'll anoint someone to run in my place, and I'll give them all the funding that I've gathered so far. All of a sudden, we're immediately down on the red line, if that happens. All right, so if something like that happens here, the market likely will decline. The market does not like indecision, so the market will likely decline. So watch what happens in these two conventions and see if anything changes. All right, let's look at the year in a different way. This is called the January barometer. This is something that was put together by Stock Traders Almanac. It's made up of three components: the Santa rally, which is last 5 days and the first 2 days of the year. We ended up negative this year. The first 5 trading days of January was basically flat, but it was a little bit negative. And the full month of January was up 1.59%. All right? So that's where we are right now. So this is what Stock Traders Almanac says. When 2 out of the 3 are negative, there were only 3 years besides 24 that happened in. Two of the 3 were negative. And when that happens, the year usually ends, on average, up 20%. Okay? So that looks pretty good. Combine that with the presidential cycle. Presidential cycle looks like the year is going to be higher. The January barometer looks that way. And now this is another view of the January barometer done by Earnings Beats, where they took every single year back to 1950, and they ranked them based on how January did. So this is the best January out of all of these years, 1987, and this is the worst January out of all of these years. Now notice the best January ended up with a negative almost 10% for the year. And the worst January ended up with a positive 35% for all those years. So those are the outliers. Anybody that understands statistics knows you throw out the outliers and then you look at the data from there. And we'll look at that in just a second. Actually, those are still working over there. What I want to point out is that for the S&P, we are in quartile 2. So that green line right there, remember I said 1.59% for January? We are in the second quartile right down here right now. So that's where we ended January. So let's see what happens when we are in the second quartile. So these are the quartiles for S&P, NASDAQ, and Russell. For the S&P, we're in the second. For NASDAQ, we're in the third. And the Russell is in the fourth. But let's take a look at the S&P for the second quartile. And what you'll notice is, first of all, the balance of the year being positive. It doesn't say how much positive, but it's between 0 and 10%. 84% chance of the market being higher by the end of the year. 84, and that's analyzing the data back to 1950. There's a 58% chance of the market being over 10% by the end of the year. Also pretty good. Well, let's look at the other side. Negative 10%, 5.3, that's 1 year. Only 1 year in quartile 2 over that whole 50-year period was less than 10%. And less than 20% is 0. There were no years that had losses over the last 50 years. So again, I think all of the evidence is lining up that we're going to have a pretty good year in 2024. Now, again, these are averages. It's not a guarantee. Doesn't mean that we will, but it looks pretty good. All right, this final piece I want to kind of dovetail on what the uneducated economist talked about. Is he still here, by the way? Okay. Well, first thing I want to say is he didn't really sound that uneducated to me. He sounded pretty educated. In fact, it was the presentation I liked the best. I'm not a real estate guy, right? So I liked the thing that he talked about. But I want to talk about CPI because CPI just came out last week. This is CPI, and for those that don't know or haven't watched Zuber and I on the channel, CPI is calculated based on a 12-month moving window called the base effect. So every time a new CPI comes out, the previous one drops off. So the one that came out last week, a pretty big one dropped off right there. Now, that should imply, now remember, CPI was 3.3% last month. We all thought it might get to 3. The forecast said 2.9. There was something that I didn't look at that I should have, that probably would have warned us it wouldn't have gone that low, but it did go down. So it went from 3.3 to 3.1. The 3.1 right now. This is core CPI right here. All right, so look at the next one that drops off. This is the one that will come out in March. That's also a pretty big one. So it's going to show CPI coming down even more in March. We might get below 3% on that one. This is what I didn't look at that I should have. These are all of the rate hikes back from the beginning of 2022. It started with a quarter, then 50, then 75, 75, 75, 75. 4 75s in a row. And going back to what I talked about earlier, that the market is always ahead of the economy, and a comment that's often made, don't fight the Fed, right? So if the Fed is raising rates, then you shouldn't be in the market. Well, here's what the market did. For these two 75-point raises, the market hit a low right there, actually went up right there, and then hit another low right here. But for every other hike, every other rate hike after that, the market just continued higher. Now, why would that be? Because the market's looking ahead. It's not looking at the data today. It's looking at where the data is going to be 6 to 9 months from now. And it knew that 6 to 9 months from now, the Fed will be done raising, and the Fed will be starting to cut. So the market already knew that. It's already priced in. So right here was the bottom right here, and we are continuing higher, and we hit all-time highs up here. All right, now, the thing that I should have looked at but didn't on CPI was the commodities right here. So over here you have oil, gasoline, CRB is made up of these components, and agriculture. And agriculture in particular, the food part of CPI, spiked dramatically the month before. You see that? So if we had looked at that, if we had been on the channel and looked at this, which we didn't, but we probably would have said it's probably not going to go below 3 because of that. Now, the next one is also going to be a big gap, so it should come down more, but we need to watch these things. So you can see now we're into the next month that's going to be reported. Gasoline and oil are kind of hanging in there. Gas actually has gone up a little. CRB is sort of hanging in there. This is the key one, I think, though, food. So we got to watch the DBA and see if that continues to drop. If it doesn't, then we might have another bad CPI number. All right, this is the one here that I put in here yesterday after the educated economist talked about. Do you remember when he said mortgage rates went up to 8%, even though the Fed hadn't stopped raising rates at that point? So I thought to myself, well, I have a chart for that. So this is the chart. The blue line here is 30-year mortgage rates. This goes back 33 years, by the way. So the first thing to point out is that, a lot of people have said, oh, the Fed has raised rates dramatically. Rates are really high. Well, they're not really high. Rates are normal. This is the way they normally are. We have, and this gray area back here is the Fed rates right here. So look at this whole period after the financial crisis where rates were down here. That's 2007, 2008 period. So anyone that was around 2008, that's 15, 16 years ago, there are probably people in this room that might have still been in high school or college that had no idea that rates could be anything but 0. They didn't know that the rates that they're at right now is normal. Those are normal rates. That's what the Fed did. They brought things back to normal. Now, yes, they can cut if they want to, but now they have the ammunition to cut because they brought things back to normal. The other thing to notice, which I thought was really interesting after listening to the educated economist, this is the S&P, this really light one in the background. But he said mortgage rates went up to 8%, even though the Fed hadn't finished its rate hikes. Well, the truth is, mortgage rates actually went up close to there before the Fed even started its rate hikes. So why would that be? It's ahead of the economy, right? So you can see the line right here. The blue one and the pink one is the 10-year yield, which they kind of pretty much move together. So the 10-year yield and mortgage rates, and then the gray shaded area right behind it, that's the actual rate hikes. But you can see mortgages and 10-year yield actually went up about a month or so before the Fed started hiking. So the stock market is always ahead of the economy. And this is PCE, which is coming up on the 29th of February. PCE basically is, so CPI is the cost of goods in the economy. PCE is what real people are actually spending for those goods. So just because the price of goods went up doesn't mean people are going to buy them, right? So PCE is what the Fed now uses as their primary indicator for inflation. So that next report comes out on the 29th. So you can see CPI down here, core CPI, and PCE. So we've got, this hasn't completed right there. A different way to look at this is right here. And interestingly, this actually says the Federal Reserve's long-run goal, 2%. That's what the educated economists taught us yesterday, right? It's not just a 2% inflation rate. That's not what the Fed is going for anymore. They're looking at a long-term 2% rate. So that's the long-term rate right here, and this is headline CPI and core CPI, but this is PCE right here. This is what the Fed is going to look at. That number on the 29th is going to be really important, because if it shows a spike again, then the Fed is not going to cut. And I am saying they won't cut until June. So that's not a prediction, that's just my opinion. All right, that's the end. I have a website if you're interested in joining. There's a special Vegas promotion. Just type that in, and you can do that. And now we'll do questions, right?
I know you, so we'll get into that in a minute. So if you haven't figured out yet, I told all the presenters to go for 20 or 25 minutes so that we could do Q&A, because everybody has roughly an hour. I mentioned I knew Dan Bird for 15 years, yeah? He highlighted that he reported me for a while. He's a wealth of knowledge. He also loves to educate. That's his passion. And also, I knew there was no chance in hell he would be done in 20 minutes. No freaking way. So what we're going to do with Mr. Dan Bird, because I know a lot of you have stock questions and charting questions and all of that, is he brought his laptop, because he likes to serve. It's right up there. You can see it right there, that old HP laptop. So line up, ask questions. He will likely bring up charts. He will go deep. There will be no short questions with Dan Bird, I promise you. But you will also get your answer. So go do that, Mr. Bird. We've done lots of President's Day Club. No, I'm talking. So the craziest award I saw given when we were together was a surfboard. Do you remember that one? Yeah, that was great. How the hell are you getting a surfboard home? I mean, that was stupid, right? I mean, you just don't bring it. Leave it in the hotel room. The maid's got a surfboard.
How do I get that through security? Because I'm going to wear it.
Well, throw it through. It should be fine. It's not a gun. It's not a knife. You'll be good. But here's your championship belt.
I want to say one last thing, and that's to thank my wife for putting up with me for so long. When I retired, I set up 6 screens in my office, and my office faces into the house. So when she walks by, she doesn't know if I'm there or not, and I'm there a lot. So I have to thank her for putting up with me.
Thank you very much. Thank you, buddy. Again, go see Dan Bird, stock questions, market questions. Watch us on Sundays. The other thing about Dan Bird is he's such a giver. Sometimes Sundays don't work, right? So what does he do? He does them solo. How many likes those solo versions? Woohoo!
I have a question for the group, because I had a couple of people commented that I should have my own YouTube channel. Do you guys think that I should? Zuber's been saying that too, so I'm thinking of putting some content together and doing that.
Let's go. All right, go see Dan Bird. You have your questions, all of that stuff. Dan, thank you very much. And I knew there was no chance in hell he would be done in 25 minutes.